Trump going to fire Fed Chair Jerome Powell? Why is he considering it? What could happen if he does? Why it matters, and what the bigger picture is. So this week, Jerome Powell gave a speech at the Chicago Economic Club where he gave very hawkish speech. Basically said, our two mandates, which are stable prices on the one hand and stable employment on the other hand, are in tension with each other due to the tariffs. On the one hand, tariffs could theoretically lead to elevated prices. We don't know yet, but we worry they could lead to higher prices. But on the other hand, tariffs can also lead to kind of decreased aggregate economic activity, leading to higher unemployment. This is basically stagflation. This is the concern that Jerome Powell expressed, and that these two, because of the tariffs, their two policy mandates are in tension with each other. Very hawkish speech. We have no intention of cutting rates. We need to see how the tariffs play out. We need to kind of wait and see. So this goes back a long time, going back to Trump's first term. He was inaugurated back here, February 2017. And in white here, we see core CPI. This is the year-over-year change of CPI, meaning not the total price you pay, but the rate of change, right? Prices are always going up. It's just how fast are they going up? And core CPI removes food and energy from the calculation, which can be more volatile. This is one of the metrics that the Fed actually looks at is core CPI, not the headline CPI that you might hear about. And then in red, we see the federal funds rate. This is the overnight interest rate set and controlled by the Federal Reserve. And we see during the first term, core CPI was below 2%, well below 2%. But yet, under the first Trump term, Jerome Powell, who was appointed by Trump, took interest rates higher. And despite, inflation not really being a concern, if anything, being lower than they wanted it, took the interest rate higher, given kind of low inflation. So during the first term, this really upset Trump. There was constantly this kind of battle where Trump was trying to, intimidate Powell into lowering rates, and many people might remember that dynamic. So that's part of the kind of context here. Is this has been going on for a long time. In white, we see what happened with the kind of huge amount of money printing and the high inflation that Americans experienced. The rate of change has been coming down pretty substantially since the peak here in kind of late 2022. The prices are still going up, but they're just going up less fast. And in fact, core CPI fell below the Fed target of 2%. So theoretically, inflation is not high enough right now. And yet you have, Jerome Powell indicating we have no intention to cut rates. So I'm not saying it's correct or incorrect, but Trump's interpretation or his view, his opinion is that Jerome Powell has been political. We know that they started cutting rates back here mid last year. August, September was the start of kind of this cutting cycle that we saw. Back during that time, inflation was about 2.5% on the core CPI metric. So about 25% higher than the Fed's own target. And yet they were cutting interest rates under the previous administration. So this is something Trump, sees as political, right or wrong. I'm not making a judgment call on that, but objectively, they were cutting rates when inflation was above their target and significantly higher than it is now. And now that it's below 2%, actually too low, they're saying we don't have any interest in cutting rates. So objectively, that is just kind of the context that we find ourselves in. So what, other than firing Powell, which brings about legal concerns, and there's a case in the Supreme Court that'll be important to watch in terms of precedent for whether or not Trump has this authority. But given that he was elected on cost of living and inflation, he doesn't, I think, want to be tied to something that can be overtly classified or represented as inflationary. The Fed's independence, is important in an economy, and when the political people start to step in and screw with that independence, it can have pretty significant consequences, as we'll see later on in the video. And so if he doesn't want to fire Jerome Powell outright, what else can he do? Well, he could appoint a shadow Fed chair. Was a shadow Fed chair? That is basically a person where Powell's term ends in I think 6 months, 9 months, something like that. A shadow chair, Fed chair, would be, hey, Trump comes out, goes, look, guys, Kevin Warsh, this guy is going to be the next Fed chair as soon as Powell's term is up. Then you have Kevin Warsh go out and go, "Hey, as soon as I get in, I'm gonna cut interest rates by 100 basis points, by 1% or 1.5% or 2%," um, and basically kind of jawbone the markets into doing what Trump wants. We have $7-8 trillion of debt to refinance because Janet Yellen, under the previous administration, shifted a huge amount of debt issuance to the short end of the yield curve, which makes us kind of much more of like a payday financing thing where we're very reliant and kind of boxed in and trapped by the short-term interest rates because that debt is rolling over every 3 months, 6 months, and you're constantly needing to refinance it by issuing new debt to pay off the old debt, and issuing new debt to pay the interest on the old debt. But that's a different story. So jawboning the market into doing what everyone what would benefit the American people in a lot of ways. Our interest expense is now higher than defense spending. It's now over $1 trillion a year. It's now over 20% of tax receipts. Um, which is typically kind of like an emerging market debt crisis. And we've been there for over a year, about a year, where interest expense is over 20% of tax receipts, revenue for the government. So we're clearly in a kind of the beginning stages of a debt crisis becoming more acute. And we need lower rates to finance this huge kind of 7-8 trillion at lower rates. And so if you have this guy come out, basically tell the market, this is what I'm going to do as soon as I'm in office, that could actually work. And so here we see in white the 2-year treasury yield. This is a shorter term bond, only 2 years. It moves much more closely to the federal funds rate rather than the longer bonds, which move more on inflation and fiscal concerns and that kind of thing. And then in purple, we see the federal funds rate. And what we can see is that going back, decades, the 2-year treasury moves before the federal funds rate. So in white, again, we see the 2-year yield. We see that that moves before the Fed moves. And it works in both directions. The 2-year treasury yield comes down before the Fed starts to cut. And it also goes up before the Fed starts to raise rates. And this dynamic is true. Look, going back basically every cutting cycle and every hiking cycle that you look at, the 2-year treasury is moving before the Fed. Um, and remember, markets are forward-looking instruments. The market is always looking and trying to discount the future. So this is an important concept. The Fed, controlling the overnight rate, they like to make it out to be they are coming to this decision independently. They are this all-powerful, strong, independent, institution, and they're making these decisions based on their supreme wisdom. Well, in reality, the bond market is basically telling them where to go, and forcing their hand. And the 2-year treasury yield and the federal funds rate never diverge for very long before inevitably the Fed, they kind of come into balance. So all this to say that we can see back before the big money printing or during the big money printing, we saw the 2-year treasury yield shoot higher way before the Fed started to cut rates. Raise rates. And same thing back here. The 2-year treasury was moving higher before the Fed started to raise rates during Trump's first term. And then it started to, it peaked and started to move lower before the Fed inevitably cut rates. And so basically what a shadow Fed chair could do is this. He could basically kind of jawbone the bond market into lower rates. And now, it's not a perfect one-to-one thing, but I think it could have a huge impact. And you would avoid the kind of negative optics of firing the Fed chair and, allegations of kind of, political intervention. Normally, you don't see that in a country like America. That's more of an emerging market thing. We'll get into that in a little bit. So I think that this is part of a bigger story that not enough people are paying attention to. For over a year, I've been saying they need a weaker dollar. The American people need a weaker dollar. The dollar is too strong. Like this is it's getting to a breaking point. So remember that when you talk about the strength of a currency, there's two sides of the coin. On the one hand, a strong currency makes imports very cheap. But on the other hand, it makes exports very expensive for the rest of the world. So, what we've seen with this kind of strong dollar policy that both parties have engaged in for many decades is that we've hollowed out our real useful productive economy. And US manufacturing becomes less and less competitive. And we rely more and more on imports. So, this has been just the way that it was, under both parties for multiple decades. But that seems to be coming to an end. Trump is coming in saying, "Look, we want to rebuild the middle class. We want to rebuild, good paying jobs here in America instead of outsourcing them and offshoring to other emerging market, cheaper labor countries." And I think these things are generally speaking moving in the right direction. Implementation is a whole different story. Execution is a whole different story. But in general, the bottom 90% have not benefited from globalization and kind of this strong dollar policy where basically what does benefit? Well, it's Dutch disease. Just like when the Netherlands discovered a huge natural gas field. When the US dollar becomes your primary good, your primary export, what does well? Finance. Wall Street does really well. Um, Financial services, insurance, real estate, these kinds of things do really, really well. So this is why this hyper financialization of the economy has happened is because of the strong dollar. It's a direct one-to-one, causal relationship. And so, the top 1% have benefited massively from running these ever larger trade deficits, which are balanced by capital and financial account surplus. Um, but the bottom 90%, their wages in real terms, in real purchasing power terms, have fallen between 40 and 80% since 2001. When China was admitted into the World Trade Organization, depending on how you calculate it, whether you use M2 or gold, the real purchasing power of the average American's wages have fallen relentlessly for year after year after year. This is why we see the suicide rate at levels not seen since the Great Depression. This is why we see drug overdose deaths and deaths of despair just shooting higher, parabolic. This is why we see birth rates plummeting. Home ownership rates of the youth are plummeting. All these second and third order effects. Antidepressant prescriptions have increased like 300%, I think, since 2000 or 2001. So all these things and growing populism, growing political polarization and social strife. All of these things are economically rooted or rooted in kind of economics. And clearly we are entering kind of a new regime. And it's not an overnight thing. It's not going to be just Trump, in my opinion. This will be both parties will move in this direction over the next 5, 10 years. And we will see growing populism and growing efforts to reverse globalization and this kind of strong dollar policy. And so, all of that to say, how do you get a weaker dollar? How is a currency valued? Currency is valued mainly on three different things: interest rate differential, which includes, kind of aggregate overall economic health. And in here on this chart, we see in white the interest rate differential of the US minus Europe. So as this white line goes up, you are getting higher interest rates in American bonds than you are in European bonds. And then here down in purple, we see the US dollar over the euro. Remember, the numerator means if this line is going up, that means dollar strength. If this line is going down, it means dollar weakness. And so, yeah, so here we see interest rate differential, and this includes kind of this includes things like GDP and kind of the overall economy, because that is ultimately at the end of the day what the treasury yield is representing, what the bond yield is representing is kind of nominal growth expectations. So this interest rate differential is a huge driver of the value of a currency. And we can see that, there's kind of this bigger, longer term trend where interest rate differentials in general have been higher, right? You're getting higher interest in American bonds in general over the past, couple years than you have been in European bonds. But yet, you look at the strength of the dollar versus the euro, and of course, there's other currencies. I just picked one for educational purposes. But in general, we kind of see more of like a downward trend in the strength of the dollar. And this goes back, long before Trump. So this is one of the main drivers. Well, if you have a shadow Fed chair that is jawboning markets down, jawboning rates down, right? We see that the U.S. yield relative to the European average has actually been shooting higher over the past month or two. But yet we've seen this kind of dollar weakness, right? And pretty sharply. Again, it's part of a bigger picture of kind of dollar starting to roll over in terms of strength, where interest rate differentials in general are trending upwards, right? So the dollar should be strengthening, and again, this goes back multiple years. And of course, notably here recently, we've seen a huge kind of divergence, right? It really kind of accelerated recently, but it's part of a bigger story. So bringing interest rates down relative to other countries is a way to weaken the dollar. So, if you can have a shadow Fed chair, we can, bring rates lower relative to the other countries. That is one way to weaken the dollar. Well, what is the second way that a currency is valued? Supply and demand. Supply and demand, we know the dollar is the reserve currency. So there is all of this persistent, inelastic demand for dollars by the rest of the world. This, given a constant supply of dollars, leads to a strengthening of the dollar. And we've showed the trade weighted dollar. I'll put it here. This is the trade weighted dollar here in white. And we see, that this trend has been going on a long time of kind of overall dollar strength, where the dollar appreciates and goes up into the right and gets stronger and stronger and stronger. Again, making U.S. exports less and less competitive, making imports cheaper and cheaper. But supply and demand. Well, if we assume a constant supply of dollars, there are of course variables with the supply, but let's just assume a kind of relatively stable supply. Uh, how do you reduce demand? Well, the reason the dollar is so overvalued is structural. It's due to the reserve currency status. This is Triffin's dilemma. This is what Triffin forecast would happen in 1961. Um, well, if you start to indicate to the rest of the world, hey, we don't want you buying our dollars anymore, you go after the demand that the foreigners have for your currency that is inelastic and price insensitive. You go after that, right? You say, the executive order in February, hey, China, all those, US dollar assets that you've been, accumulating over the past 2 decades, we don't want you doing that anymore. It was a shot across the bow to China. We don't want that. We've also indicated to the kind of generally speaking, the rest of the world, that this, kind of trade, this positive carry US dollar carry trade is kind of coming to an end. And if you're a foreigner, we might start taxing you, right? You hold dollars or treasuries or US bonds or anything denominated in dollars, we might tax you. In fact, the chairman of the Council of Economic Advisors, Stephen Moran, wrote a whole paper on this in October, November. Basically, one of the ways you kind of address all these deep economic issues here in America is by kind of reducing the demand, the foreign demand for dollars. So now, why is that important? So here we see the balance of trade, which is again the main component of the current account. There's kind of two main accounts. There's the current account, capital and financial account. The trade balance is the vast majority of the current account. And so here we see this ever increasing trade deficit. And we see that recently it just blew out. I mean, just blew out completely in January. And what this means, current account deficit must be balanced by a capital and financial account surplus. So in purple, we see, what could be approximated to be the current account, the capital and financial account surplus, right? So as we are importing more and more and more and exporting less and less and less here in white, um, in purple, more and more money must be flowing into our capital and financial account. What is that? Well, that's foreign direct investment. That's portfolio investment, which is just buying U.S. stocks, U.S. Treasury bonds, that kind of thing. There are kind of multiple elements to it, but generally speaking, foreign money buying U.S. assets. So we know that this is just a basic international kind of accounting. The balance of payments, current account deficit must be balanced by an equal amount of money flowing in, capital and financial account surplus. So if we're running a $120 billion a month trade deficit, that must be balanced by $120 billion a month flowing in to our S&P 500, real estate, farmland, single family homes, US treasuries, right? This is just how it works. And so a really important dynamic that I'll expand on because it is massively under discussed. But I want to show what ends up happening from this system, from the strong dollar, ever increasing trade deficit sort of system. So here in white, I just inverted the trade deficit, right? So as this white line is going up, trade deficit's getting worse. Here is the single family home price divided by the median family income. So this is basically the affordability of a single family home in America in purple. And we can see that it follows the trade deficit. So as the trade deficit improves, less money must flow into capital markets and financial assets. And what do you know? The affordability of homes improved. And during this period of time, the trade deficit was growing and the unaffordability of single family homes was growing. Homes were getting less and less affordable. Here, there's kind of clearly your eye might be going here. There's this kind of huge divergence from the trade deficit, which stayed flat here in white, but the affordability of homes got really bad. This was during QE2 and QE3, where $1.7 trillion of basically money printing to buy financial assets was occurring by the Federal Reserve. So this is why that diverged. The affordability of homes diverged from this kind of structural flow of dollars, which is more what we see in white. And then the reason it returned back here, the reason it kind of started to return to did a mean reversion is because quantitative tightening was started to be engaged where the Fed was shrinking the size of their balance sheet. So doing the exact opposite of what they did here. And so this is a super, super important concept to understand. Here, we see in 2020, 2021, trade deficit blew out, right? Everyone remembers we couldn't make anything here in America. We relied on the rest of the world for everything. Trade deficit blew out. And what do you know? The affordability of housing got really bad. As this purple line is going up, homes are less affordable. And then as the trade deficit started to improve here in white, as this trade deficit started to improve, what do you know? Single family homes got more affordable. So again, this is a structural thing, hundreds of billions of dollars per month of structural bid in US assets. Now, this also works for corporate profits. So now here in purple, we see corporate profits. And we see that this correlation is very strong. As the trade deficit gets worse, corporate profits go up. Corporations do better. So this also applies to the S&P 500. So if you hold financial assets, if you're an asset holder, wealthy asset holder, you do well with a growing trade deficit because there is this equal amount of capital that must flow into financial assets. And so this dynamic is massively under discussed. We've been banging the drum on this for over a year. And I think it's really important for people to understand there are structural reasons why wealth inequality has gotten to levels not seen since the Gilded Age. This is part of the structure of the system. If you want to improve wealth inequality, if you want the bottom 90% to do better and not have wealth, so concentrated in the top 0.1%, the top 1%, where, these multinational corporations are doing better and better and better, their profits are soaring, but yet the average, 90% American, everyday American is doing worse and worse. This is a structural reason. The trade deficit is a structural reason for this dynamic. And I'll just show a couple quick charts on that average American. This was inverted. So here we see in in white, we see the average hourly wage. Let's divide it by the S&P 500. Did it backwards, sorry. Okay, so here we see the S&P 500 divided by the average hourly wage. So what this indicates, what this shows us, is the number of hours at the average job to buy one share of the S&P 500. And I'll go back even further here to the 60s and 70s. We can see that, historically speaking, it was about between 15 and 25 hours of work at the average job to buy one share of the S&P 500. Then what happened? Well, globalization took off. Here in 2001 was when the China was admitted into the WTO. This is when, globalization really started back in the 90s, but, it really kind of accelerated after the mid to late 90s. And what do we see? We see this huge run up in the S&P relative to wages, meaning that, the number of hours at the average job went from being in the height of 2008, the GFC went from 40 all the way up to, at the peak that we had just seen a couple months ago, 200. So what this means is that wages have lagged the S&P 500 by a huge amount. So the S&P has outpaced wages even to the current levels by 300% since 2008. The S&P has grown 300% faster than the average American average hourly wage. And of course, you can also look at U.S. wages divided by gold. This shows you kind of an inflation-adjusted real purchasing power of wages. And we see, this was the Nixon shock, in the gold story. But here, this is when China was admitted into the WTO. And we can see that the average hourly wage, the real purchasing power of the average hourly wage since December 2001 has fallen by 82%. When using gold as an adjustment for kind of inflation and money supply. You can also look at it. You can use the actual money supply. There's kind of no better way to adjust for inflation than using the actual money supply. I mean, this is brutal. This is why you have suicide rate so high and drug overdose deaths and political polarization and antidepressant prescriptions skyrocketing and social strife and all these issues in America, is that the average American's been getting completely screwed for the longest time. Meanwhile, the wealthy are doing better and better and better. And so I'll show this as one final chart to illustrate this dynamic. Here again, in white, is the balance of trade, and then we will look at the net worth of the top 1% in green. And whether you look at just the nominal number, this green is the net worth of the top 1%. You can see the same correlation, right? It's trending higher as the trade deficit is getting worse. As the trade deficit improves, the net worth of the top 1% declines, right? As trade becomes more balanced, the net worth top 1% do worse. And then kind of generally speaking, as the trade deficit is increasing, the net worth of the top 1% increases along with it. If you look at the net worth divided by GDP, this shows you the relative share, the net worth of the top 1% as a relative share of GDP. You see kind of a slightly more tight correlation, but both directions you see the top 1% do better and better. I mean, we know that they hold the vast majority of financial assets. We know financial assets do better and better as the trade deficit goes up or gets worse because of this structural bid into U.S. assets. Over $100 billion a month of structural bid. And we know the top 1% hold the vast majority of those financial assets that do so well. We know multinational corporations do very well as the trade deficit gets worse. So all of that to hopefully illustrate kind of, I think, the broader context of this weak dollar, right? If we can balance trade and bring this trade deficit, improve this trade deficit, the structural bid into financial assets, including single family homes, will get better. So young people will actually maybe be able to afford the American dream. The S&P 500, it might not be so great for and we'll get into this kind of my forecast in a little bit here, but I think we're seeing this kind of fourth turning secular shift towards populism, regardless of party. I think that we are entering kind of a new regime. For the past few decades, we have been in this ever increasing globalization, which has benefited the top 1%. It's benefited, holders of financial assets. But, the bottom 90%, as we saw with the average hourly wage, the average American's been getting decimated. And so I think both parties will try to address this trade deficit. I think both parties will try to reorient the American economy into one that is net productive. And to illustrate this, here we'll look at GDP in white. And we will divide it by M2. So what this does is it adjusts for money printing. Oh, used the wrong M2, wrong GDP. I don't know why it always does that. I don't want to look at the LSE. Okay, so here we see GDP divided by M2. So what this does is it adjusts for money printing. We know money printing and government spending is a huge part of GDP. This adjusts for that. And what do we see? We see that, in the late 90s, real GDP, adjusting for inflation, adjusting for money printing, has actually been falling, right? So what we're doing is printing more and more money via debt. We're issuing more and more debt that we can't afford to try to kind of prop up GDP. But in fact, we're getting less and less return. And the same is true if you use gross federal debt. We see the same dynamic. No matter how you look at it, once you kind of adjust for debt and adjust for money printing, the story, the GDP that everyone talks about is really not what it really is. We're just increasing the debt. This data series is a little more clean. We're getting less and less GDP. We're increasing the debt faster and faster to get less and less actual real productive, net productive economic growth. This is not sustainable. This eventually leads you to, and now, this goes back to the 80s. If you divide by the gross federal debt, we stopped getting real economic growth in the 80s. We had a period of time here in the, late 90s with where GDP actually outpaced, GDP growth outpaced debt growth. But in general, this story, whether it's the average American that we looked at with the average American's wages, or real net GDP, right, after adjusting for debt, after adjusting for inflation and debasement, currency debasement, we see the same story. The the American economy is kind of all one big mirage. And so I think both parties will try to fix this and try to address this. And the way you got to do it, you got to balance trade. You need a weaker dollar to do that. Tariffs alone are not enough to do that. And so that gets us into the debt story. So the debt has gotten to a point where I think the situation is becoming acute. Over 120% debt to GDP, only ever seen once, which was after World War II. Interest expense as a share of tax receipts, 20%, over 20%. Mandatory spending, over 100% of tax receipts, government revenue. Right, 7% pro-cyclical deficit, all these things. So debt is becoming more and more of an issue. Now, the last time it was this high was after World War II. Well, how did we get out of that situation? We ran negative real rates. Basically, the bondholders need to lose. They need to lose in real purchasing power terms. America will not default. America will not say, hey, we're not paying anyone what we owe you. They won't do that. I'm sorry, that's just not going to happen. What they'll do is financial repression, is a fancy term for this, where you run economic growth, you inflate the debt away, right? Where the GDP is, say, 10%, but you limit the interest rates to, say, 1%. Well, that means that 9% every year, the bondholders are taking a 9% haircut. They'll get back every dollar that they're owed, but the dollars they get back will not purchase nearly as much stuff, real stuff. So you have to devalue the debt in real terms. Here we see TLT, which is the long U.S. Treasury, the value of the bond, not the yield, but the value of the bond, divided by gold. So this is kind of adjusting for currency debasement, which gold is a pretty good proxy for. And then in red, we see TLT, which is the long U.S. Treasury, divided by the S&P 500. And we can see that this story goes back a long time. We know in 2014, here, we know that foreigners on a net basis stopped increasing their treasury holdings. This story has been a long time in the making. 2014, 2015 was kind of, the end of net increases of U.S. treasuries by foreign central banks. What they have started to shift towards is gold. This is part of the reason we've seen gold run up so much in the past couple of years. But this story of kind of the bond losing value in real terms is, I think, going to accelerate and going to continue. And I think real returns must be negative. The interest rate, the real rate on U.S. Treasuries, which is the yield minus the inflation rate, the real return must be negative. That is how you de-lever the sovereign balance sheet. And so I think that this story will continue, and this is one other way you get a weaker dollar. No one wants to buy U.S. Treasuries if you know that the U.S. is in this untenable fiscal position and their only way out is to do financial repression and inflate the debt away. That is one way to weaken the dollar, right? After World War II, we capped interest rates. We said, hey, I think it's 2.5%. We said, anything above that, nope, we're not. Like the bond market, yeah, you can, the bond market's goal is to price this in, right? And if they think inflation is going to be 10%, the bond market will take yields to 10%. Well, eventually you get to a point where that's not tenable. I think now the US can't afford anything much more than 4.5, 5, maybe 5.5 at most. But anything above that, and the government will be forced to step in and basically cap rates. Say they cap it at 3%, and then you run GDP and inflate nominal GDP, which counts inflation. You just run that at 8%, 9%. That is the way to get out of this debt issue. And so I think it's part of this kind of bigger dollar weakness, weak dollar thing that we're trying to kind of explain here. And so the last way that a currency is valued, we went over interest rate differentials, we went over supply and demand, and kind of this, the fiscal concerns, which affects supply and demand. And then The last way is on a balance of payments basis. So, in general, balance of payments refers to kind of the economic health of a country, right? If you're running a twin deficit where you are, it's kind of equivalent to a household that you make 50K a year, but you spend 130K a year, and every year you got to go to the bank and ask for more debt, higher credit limit because you need to pay off the old debt and there's interest. So that is growing faster and faster. So every year you got to go to the bank and ask for more and more money. Uh, it's just a simple example to hopefully explain this concept. But America's been running a twin deficit: fiscal deficit, which is government spending minus government revenue. That's the fiscal deficit. We've been running a huge deficit on that, and then we've also been running this huge trade deficit that we just kind of went over. So, on a balance of payments basis, on a fundamental basis, the dollar is overvalued. The only reason the dollar hasn't collapsed as the twin deficits grew is because of the reserve currency status of the dollar, which we know, Triffin's dilemma, leads to hollowing out of the real productive economy, the middle class, right? Like all the things we kind of just went over. Um, so you need a weaker dollar in order to get out of this situation. And on a balance of payments basis, the dollar is, between 40 and 60% overvalued. Luke Groman thinks it could be higher, as high as 80% overvalued. This is just the reality of the situation. There's no free lunch. At the end of the day, everything kind of gravity always wins. And for the longest time, America was just kind of behaving as if gravity didn't exist, and it's kind of finally all starting to catch up with us. And there is no free lunch, right? So whether that be kind of S&P 500 and stock market returns, whether that be the debt and U.S. Treasuries, right? Like all these things, eventually gravity comes due. The bill comes due, and we are getting to that point. So this is the other way. Negative real rates is another way to get a weak dollar. And you also, de-lever all the debt. So you improve the debt to GDP. So it kind of you killed two birds with one stone. And if you really want to be efficient, you could kill three birds with one stone. Use negative real rates to finance that reindustrialization, which is going to cost a lot of money. And the way you get that is by yield curve control, QE, something like that. And so that's kind of the weak dollar story. The kind of this is a weak dollar issue, but it's also kind of the Fed chair as well. What are some examples of countries where the political the political, the administration, the government starts to get involved with monetary policy? Well, here in white, we see Turkey, the Turkish stock market, right? Think like the S&P 500 for Turkey. And then in red, we see Argentina's stock index in white, or sorry, in red. In white is Turkey, in red is Argentina. And these are denominated in their local currency, right? So this white line is in Turkish lira, and the red line is in Argentinian peso. This looks great. You look at this, you go, oh, well, if we're kind of headed to this deleveraging, financial repression, negative real interest rates, inflate the debt away, right? Like I should buy stocks. This that looks crazy. Well, it does in nominal terms, right? In terms of that local currency, sure, it looks great. But once you adjust for inflation, it looks a lot different. So in white, we, instead of denominating these in their local currencies, we'll denominate them in the dollar. You can see it's a lot different story. And now, of course, the dollar is not without inflationary concerns either. But it becomes a much different picture when you kind of adjust for the fact that the reason those stock markets look so good in nominal terms is because the value of the currency is plummeting. So once you adjust for the plummeting value of the currency, it looks a lot less good. And so I think, this is kind of a dynamic that now I'm not saying that the US will become Turkey or Argentina, hyperinflation or any of those things. I genuinely don't believe that any of that will happen. I think that it's much more likely we see sustained 6, 7% inflation, um, unfortunately. But there is a world where if this kind of reindustrialization works and the reshoring and kind of rebuilding of the middle class and the rebuilding of the useful economy, the net productive into a net productive economy, you could see a world where CPI inflation is 6, 7%, but the average American's wages are growing at 9 or 10%. So the average American is actually doing better, right? In that world, stock market is probably not doing so great. Bonds are certainly not doing good. They're getting crushed in that potential scenario. Um, Gold is doing very well in US dollar terms. Gold or Bitcoin, scarce assets are doing very well. Real estate is probably going up in price in that world. Now, in real terms, real estate might not be rising as much, but in nominal terms, in US dollar terms, real estate will certainly go up in this kind of environment. So it's just to illustrate that just because a line on a chart is going up, right, and this applies to the U.S. too. I'll show you that real fast here. You look at a chart of the S&P 500 and it looks great. Who wouldn't want to buy the S&P 500? I mean, this thing looks amazing. It's a parabolic uptrend. This thing's literally exponential, you know? But once you adjust for the falling value of the dollar, it's gone nowhere. It's gone nowhere since 2000, right? 2000, we saw this huge run up, and I will also remind people, remember that real GDP chart we looked at earlier. This was the last time that we got real GDP after adjusting for money printing. Was kind of this late 90s, early 2000s. This is when China was admitted into the WTO in 2001, and globalization kind of really took off. And of course, this was dot-com bubble. There are other factors at play, but you can see that basically this S&P 500 chart, it looks way different once you adjust for the falling value of the dollar. Um, I think, if we are entering this world, it's really important for the everyday American to understand these dynamics. What I think is the most likely is that we enter, and Cem Carson has been speaking about this analog, and I think it's really useful. And it's basically been my view for about a year or two, that in this kind of coming era, this coming regime, um, in nominal terms, things might go up, right? The stock market might go up. Um, Real estate might go up. But in real terms, it's a much different story. So Cem has been saying that, the last time we saw the kind of populism and kind of all the societal issues and the demographic analog to where we're at now was kind of the late 60s. And there's a lot of striking similarities with that kind of era. And what we saw was that, even in a nominal basis, the stock market basically went nowhere from 65 all the way to basically 1980. So for about 15 years, stock market just went up and down and then up and down and up. And it basically just went sideways for almost 15 years. And so this might kind of scare you, and you might think, well, that doesn't look too good. Well, it gets worse. So once you look at the stock market in real terms, that's what we see in red. The white is nominal terms. In real terms, which is S&P 500 divided by gold, here in red, we see it's actually much, much worse. Not, it didn't go sideways like it looks like in dollar terms. In gold terms, in real purchasing power terms, holding stocks, you actually lost a ton of value during this period of time, a ton of wealth. So I think that these concepts are really critical. I think that this is a lot of this stuff is just math. It's just economics. It doesn't have anything to do with political party or who is president. I think a lot of these things that we've been talking about in this video will apply regardless of political party, regardless of the name of the president. It's just math. It's just objective reality, objective economic truths. And so I hope this has been helpful in that context, right? I think that what we're seeing, just to touch on the question people might have, well, this populism we're seeing from the right is clearly not the Republican Party of old. Um, and the Democrats, right, recently, if you've been paying attention, we see Bernie and AOC, right? And they've raised an insane amount of money, like $9 million in a couple days. And they're kind of on this, speaking tour around the country, and they're drawing, huge crowds. So I think that, we will start to see, this goes into kind of what I was just saying. I think that we will see populism in a lot of these economic issues play out regardless of who is in power. I think it really has nothing to do with politics. Politics is kind of I think, an overly simplistic um, way to look at the world. This is the price is information. Economic data is information. And these are truths. There is financial gravity. There is economic gravity. You might try to put it off for a long time, but eventually, you can only overpower gravity for so long. And so I think it's important for people to try to focus on this stuff, and how to protect your family, how to protect your wealth, much more so than getting wrapped up in the day to day kind of political stuff. I think it just doesn't. It's not really what's driving things. Um, and I think it's much more important for people to start kind of educating themselves on these realities, because we're entering a volatile era, in my opinion. Regardless of what political party is in power, we are entering an era that many Americans have not seen in their lives before, especially if you're younger. And so I think it's really, really critical for people to get this context, and hopefully this video was helpful. Um, I will expand on some of the things we touched on in this video, deserve much more uh, elucidation and expansion on some of these topics. So if there were periods of it that you thought were interesting that you'd like to expand on, please leave a comment and I'll be happy to. I do have a whole Twitter series on my Twitter account, my X account. It's under my highlights tab. It's called Silent Depression, and it goes over a lot of the things that we were covering with kind of the experience of the average, everyday American, the average blue collar, bottom 90% American. There's a ton of charts in that post, in that thread, that ton of graphs and charts and data. So, but if there's anything that you would like to see expanded on, please just leave it in a comment. I'd be more than happy to do that. It's going to be an interesting time, regardless of kind of how things play out. It's certainly going to be an interesting time, and I'll continue to, hopefully make somewhat helpful, useful, educational sort of videos like this. If you thought it was helpful, just leave a comment of anything you'd like to see expanded on. Yeah, and I'll talk to you guys later.